Hi everyone, I'm Mike Gasior and this is my December 2006 video commentary. I hope you guys all had a great holiday and a good new year. And now 2007 is kicking off and I'm going to keep up the same trend I've been going for the last couple of years, which is making each of these months' topics sort of a little mini seminar in itself. And as I said in my newsletter, this month was going to be just sort of a primer about hedge funds. I've had hedge funds as clients for, I hate saying this, now over 20 years, and I still find, even as gigantic as the market's gotten for them, because if you don't know, best anyone can estimate there's about 8,000 to 9,000 different hedge funds being run worldwide, managing about $1.3 trillion US. And they've become a monster force in the financial markets, and most of Main Street doesn't know much about them. And I thought I'd just give you the basics. Now, number one, a hedge fund really is very much like a mutual fund. It's a pooled investment vehicle where an investment manager, professional, takes other investors' money, manages it via some style, and there are a variety of styles. And like mutual fund managers will, they charge you a management fee, typically 1-2%, although there's others charging more nowadays. But let me sort of trace this backward, because while I always want to make that comparison to mutual funds, there are some stark differences. And the whole thing can be traced back about 50 years to a guy by the name of Alfred Winslow Jones. His friends called him Fred Jones. The stock market period that I'm talking about 50 years ago, was very much like the stock market we've been experiencing the last 6 years, where it really isn't doing much of anything. It's sort of churning sideways. Very difficult to really make money sometimes in markets like that. But this Fred Jones guy, he had an idea. And his idea was simple. And any of you who have been in my classes will recognize this example because I use it all the time. To put it, let's say, in a modern terminology, let's just say that I'm looking at Ford Motor Company and General Motors stock, common stock. And this is just a fake opinion, but let's just say that I think GM has really gotten beaten up an awful lot, and Ford just hasn't taken nearly the same amount of medicine. So here's my idea. I'm going to go short the Ford stock, which I don't think has been really hurt that bad, and I'm going to go long GM. So I'm talking about short Ford, long GM. Now, if I ask you what my position is now in the stock market, you would describe it as neutral, which if you ever hear a portfolio manager describe their philosophy as being market neutral, that's what I just did. I'm long one stock and short the other one. But what I've done is I've isolated my difference of opinion between GM and Ford, because they could both go straight in the tank from here. All I need is Ford, the one that I shorted, to go down more than GM. Or they could go both straight up, as long as General Motors, the one that I went long, goes up more than the Ford. So that's sort of the essence of market neutral. And that's also where that name sprang from, hedge funds. Now, in previous discussions, I've talked about how derivatives get used for hedging. A real hedge with derivatives would be an example of a corn farmer who in real life is long corn, going short the corn futures. That's what hedging is all about, and that's where that name sprang from. Because the initial hedge fund marketplace was that simple long-short strategy. Now here's the problem for our Fred Jones fella. His idea, long one stock and short the other, was not allowed. And to this day, it really isn't allowed to be done in a mutual fund. So he had to come up with another idea, and his was create an investment vehicle that does not have to be registered, like mutual funds do, with the Securities Exchange Commission. And what he decided he would do is sell interests in his fund only to either accredited individuals or institutional investors. The important word there, and I'm talking in a U.S.-centric kind of way, is the accredited investor, which is, there's two thresholds that can be met as an individual. Either you can show me you had $200,000 of income for the last couple of years filing single, or $300,000 filing joint, or as good as that is if you could show me that you have a $1 million net worth minus your primary residence. Either qualification will make you accredited and allow you to participate in private placements of securities, which is what we're talking about. Your typical hedge fund is structured usually as a limited partnership, and you would be a limited partner investor in, let's say, Mike's hedge fund. I'm the general partner, and I'm the one running the money. So because the hedge fund is arranged in this private way and not regulated under the SEC, they could do this long and short thing. The irony also is the name is a misnomer, because even though they say hedge funds, typically when a hedge fund uses derivatives, it's almost never for hedging. Hedge funds almost exclusively use derivatives for speculation. And now there's a million different strategies being pursued by hedge fund managers, not just that long and short. They can do just long, just short, speculate in the commodities market, any number of things. And they are investing in some of the wildest stuff on earth. So there's one thing Fred Jones wanted to do, but let me mention another thing. Another thing he wanted to do was take a share of the profits. He wanted to take a 20% share of any profits. So 80% of the profits go to the investors in the hedge fund, you guys. 20% of the profits stay with me, the hedge fund manager. Now, that 1 or 2% management fee that I took, that typically just covers my overhead. My rent and heat and hot water and electricity and quote machines and so on. I don't really start making money until I'm participating in some of that 20% action. But the thing is, the SEC does not allow that in mutual funds either. They do not allow the manager to participate when there's profits. So those two things, number one, that the hedge fund is only available to these either wealthier, well-to-do individuals or institutions, and that the manager shares in the profits. And I know that seems like a big share, but it really holds the manager's feet to the fire, because they really don't make money unless the fund is profitable. And they will do anything they have to do to get it into that profitable situation when year end or whenever the 20% cut time comes. So those are the primary differences. And I just wrote it in the newsletter just passed, that on an average day now, 30 to 35% of all the trading on the New York Stock Exchange is hedge fund related. And sometimes up to 40% on the London Stock Exchange. And one guy, Steve Cohen, who runs SAC, which is Stephen A. Cohen Capital down in Greenwich, Connecticut, on a daily basis, his trading operation alone out of Greenwich accounts for almost 2% of the New York Stock Exchange and the NASDAQ volume. So it's an enormous segment of the business. Now, those are the basics. I may come back in other commentaries and we'll talk more about it. So, you know what's kind of cool? I'm sitting here, and just to be honest with you, it is January 6th. It is 67 degrees in Connecticut. This is the view off my backyard, and I can't believe it. I'm wearing a turtleneck. It's almost too much. I hope all you guys have been well. I'm excited about the new year. 2006 was great, and I'll be back to you again next month, and we'll talk about something timely, and I'll pick it on the fly. Hope you're all well. I'll see you again soon.